Hello, Vetted VA community. It is Hammer here again this week with your mortgage market update, filling y'all in with what's going on behind the scenes, what's driving those mortgage rates, which way we think rates are going, and why. And here to educate you, as always, our mission here at Vetted VA. Joined today with Michael Dendy, a Vetted VA professional. Is this a typo, Mike? Do you have 12 kids?
Yeah, I do have 12 kids.
A real estate agent and mortgage loan officer in Tennessee. So thanks for joining us, Michael. Please go ahead, take a minute, tell us about yourself and 12 kids and the wonderful people in your life that help you to raise them.
Gotcha. Yeah, my wife and I, we have 12 kids. They're all ours. Well, I didn't have them. My wife had them, but they're not adopted. My wife birthed every single one of them. And that's rare in these days, obviously, but that's me. That's also why I am a loan officer and a real estate agent. I got to close a lot of deals in order to be able to feed all these people.
Put food in those mouths. Exactly. So what part of Tennessee are you from?
I am in just south of Nashville. It's called Franklin.
Okay. Oh, yeah, I know. I'm familiar with Franklin. Yeah. So awesome. Yep. Yeah, you're over there in the that's kind of the northern part of the state, the northwestern part of the state, or mid part of the state.
It's it's middle Tennessee. It's actually Nashville's pretty much in the middle, north to south of Tennessee.
Okay.
But from a veteran standpoint, I mean, we have Clarksville is where Fort Campbell is at. It's right there on the line in Kentucky. So
awesome. Well, again, thank you for joining us today, and appreciate having you here. And so if y'all have any questions, please go ahead and ask. If you're here live, let us know. Say hi in the comments. Let us know if you're a mortgage professional, a real estate professional, or if you're a consumer. And if there's any questions that we can answer for you, especially for y'all consumers out there, that's what we're here for. You can ask us anything. We'll help you with that. If you're watching on the replay, I know many of you can't make it live. Do us a favor. Let us know by commenting. Ask any questions you'd like. We do monitor these threads each week, and also give us a hashtag replay and just let us know that you guys are watching. We get to see some of Facebook's insights, but that shows everybody that you guys want us to get on here and you want me to babble each week. So I appreciate you, and I appreciate you doing that. Like I said, if you guys have any questions or comments, go ahead and throw them up there, and we will be glad to go on there. So let's start out with talking about let's talk about what we said last week and where rates are at and all that good stuff. So let me jump forward a few slides on our slide deck, and we'll get to that part. So first of all, remember, as we talk about rates, this is not an offer to lend. When we're talking rates, we're talking averages and generalities. One of the things that you can do is to be informed, and we're here to help you to be informed, but you can also shop around and make sure that you're comfortable with who you're working with and that you're not being taken advantage of. Don't just fall for the first big name and big advertiser out there. There's a lot out there. So what did we say last week? I said rates were showing signs of holding at the levels. We'd seen all of February rates had gone up. I don't know if you remember, Michael, but rates were at their best level right at the end of January, beginning of February. At February 2nd, I had seen VA rates that were in the high fives at the time. I don't know if you had, do you remember quoting any rates in the high fives back at the beginning of February?
Yeah, we actually locked some then, and we got lucky.
Yeah. It was a nice window. And since then, all of February, we saw rates creeping up. And towards the end of February, as we started to roll into March, it looked like rates were showing signs of holding. And we said, watch that 10-year Treasury yield for clues, especially for our consumers out there. If you're looking for something, it's not necessarily going to be 100% in lockstep with mortgage rates, but it's something you can follow and see which direction things were going. And we talked about if the yield goes up, mortgage rates are likely to go up. If the yield comes down, mortgage rates are likely to come down, and that 4% yield would be bad. So what actually happened last week? Well, the rate increases did slow down, but rates were just slightly higher for the week. We saw a little bit of choppiness. Friday, we saw rates actually, Thursday, they got really bad. Friday, they got a little bit better. And that was after last week's show. And then this week, it's been kind of quiet, and we've seen a bit of a sideways move. what would you say, Michael? Have you seen something similar to what I've seen as far as the rate increases slowing down and rates kind of, being just a little bit higher for this week?
Yeah, it really hasn't been a huge change, not like we've had over the past several weeks for sure. And seeing that level off, I've done some pricing on different mortgages, and uh, really feels like I'm in a level playing field right now. So
Yeah.
that's kind of
It's kind of what I'm seeing too. It slowed down a bit. So the 10-year treasury yield did push up past that 4% mark that I warned you all about, but it only did that for one day on Thursday before it fell back, and it's in that 3.9% range. And you guys know I love showing you these fancy charts that make it look like I'm much smarter than I really am. But this shows you this 10-year. Right now we're at about 3.95. So we're in that 3.9-ish range for that 10-year. VA rates, I would say generally you're going to find your VA rates are in the mid to high sixes. And remember, rates depend on your credit score and your unique situation. You should always get a professional opinion and get a professional rate quote. But I would say that as a range, if you were quoted in the high sevens, that's a problem. If you were quoted in the low fives, that's a problem. Somewhere in the mid to high sixes, though, you're probably getting a pretty honest rate quote. And conventional rates are in the high sixes to low sevens if you're not using your VA entitlement for some reason in your VA benefit. That's what you're going to see for what we call conventional conforming rates, and the rates that most people are able to see. What about you, Michael? Do you think that sounds about right?
Yeah, for sure. I quoted out some yesterday, and we had one had really good credit and a good financial scenario, and by them doing the things the way they did, they had a rate around 6.25. But for the most part, we're probably right in the mid sixes for most people.
Okay,
on a VA.
very good. Yeah, and that's just good for people to know. So what everyone always asks next is, all right, Helmer, where are they going from here? What can we expect? So there we go. It took me backwards. There we are. Forecast. So rates are looking for a reason to improve. And I know that sounds kind of strange, but based on all these variables, and when I show you all these fancy charts, the bond positions that we see for that 10-year treasury and what we call mortgage-backed securities, which are your foundation for mortgage rates. We've talked about those, and we'll talk about them again another time. But these are looking for a reason to improve. Our technical indicators, when we look at all the charts and the graphs, they're looking for a reason to improve. However, I don't quite trust it. I'm walking on eggshells. I feel like we're going to see rates move up higher from here. Now, yesterday, we saw Fed Chair Jerome Powell. He was testifying in front of the Senate Banking Committee. Today, he's testifying in front of the House Financial Services Committee. And in his comments yesterday, it's funny because I've been telling you all that may watch more than, this may not be your first rodeo, your first show. We've talked about each week that what's driving mortgage rates right now is the belief that the Fed is going to continue to hike the Fed rate in order to slow down the economy and bring inflation to check. So different Fed members have been saying that the Fed is going to need to be more aggressive in this task, and they're going to need to raise that rate higher. Now, to put it in perspective, in December of 2021, and this is a trick question, Michael. I know you don't know the answer, but I'm going to put you on the spot anyway. That way I can look smart for a minute. In December of 2021, do you know what economists were forecasting and what the Fed was forecasting the Fed rate to be in 2023 at December of 2021?
Well, I don't know the answer. I'll take a guess.
All right, take a guess.
3.75.
1.75. 1.75. Wow. Now, to put that in perspective for everybody, it's currently at 4.5. And we're only in the first meeting for the year has taken place in February. So we're already at 4.5. Expectations are that we are going to see this Fed funds rate go up in March, that we're going to see it go up to 5. And just yesterday, if you had asked me at 9:30 a.m. Eastern time, I would have told you that the expectation was we're going to see it go from 4.5 to 4.75. But when Fed Chair Jerome Powell yesterday at 10 a.m., he started testifying in front of Congress, and that starts with a release of what they call their prepared remarks, which is his testimony that's already been set up ahead of time in a text format. Well, when he came out, he basically laid it on the line that the Fed needs to be more aggressive because they're seeing signs that the economy is improving, things aren't slowing down, and that has everybody now believing the Fed is going to raise rates in basically on the 22nd, just a couple weeks from now, a 0.5%. And that we're going to see that Fed funds rate go up to 5%, and that at the May meeting, it's going to go to 5.25%. By the June meeting, they're now looking at a Fed, what we call their terminal rate or the peak rate before the Fed pauses at 5.5. And there's some talk that we could see 5.75, and then by July, maybe even 6%. So that's what markets are currently pricing in. So what this means to everybody is that as expectations grow that the Fed is going to raise that rate higher later in the year, mortgage rates go up now. And we've talked about this before. Mortgage rates are reacting right now to the speculation of what the Fed is going to do. And so it started with yesterday. Now, surprisingly, rates did go up yesterday, but not that much. And I think there's a lot of room for rates to go up from here. And it's going to depend on two important pieces of data that are going to come out in the next couple of weeks. So the first one is on Friday. That is our jobs data. And that is where I talked about that if that jobs data comes in showing the labor market is weak, meaning that, more layoffs, less new jobs created, wages maybe slowing down, unemployment number going up, then we could see rates improve slightly. And you'll notice that I put slightly in caps because I really don't think there's a lot of room to see rates improve from here. I know that many of y'all out there are really hoping to see rates improve, but there's not a lot of reason to expect rates to improve from here. And it's important that we kind of accept and make your decisions based on that. Now, if that Friday's jobs data, again, this Friday comes in showing the labor market is strong, we're going to see rates move higher, probably at least 1/8 to 1/4%. So if your rate quote was 7% today on Friday, if this data comes in showing the labor market is doing okay, your rate might go up to 7 1/8, or in other words, 7.125 or 7.25. So that's what I'm expecting to see in a forecast. And that's on Friday. And then before next week's show, next Wednesday, we're also going to see another very important data point, and that's going to be inflation. And there's a couple different inflation readings that we monitor through the month. The one coming out on Tuesday, March 14th, is called the CPI inflation report, and that's Consumer Price Index. Now, if data shows inflation is improving more than expected, then rates could improve. And again, I think that's only slightly, though. I don't think we see a big improvement. But if we're seeing signs of inflation, because if inflation, I'm seeing signs of inflation improving, because if inflation is improving, then the Fed can be aggressive in the rate hikes on these fancy charts that I showed you here, and we'll see mortgage rates react to that now. However, if that data shows inflation is only improving as expected, or forbid, that it's higher, then we could really see rates move higher at that point. And rates could, how high they move is going to depend on how bad that data is. So if you're looking at buying, something and you're under contract and you're closing soon, and you say, okay, Helmer, well, where do you think rates are going to be? As a forecast, and again, I don't have a crystal ball and I've given you the variables, but my opinion, I think rates are going to move higher in the next 15 days. And that means you want to talk to your loan mortgage professional about possibly locking in that interest rate if you have that opportunity. In the next few months, I think rates, for VA loans are going to move into the 7s, and conventional loans will be in the mid 7s. And I think that rates in a longer term, longer being the end of the year, maybe the beginning of 2024 even, we're talking that far out, that rates will improve again once we see real signs of a coming recession. And there's a lot of expectation that we are going to go into a recession. A lot of the indications are there. When we start seeing economic slowdown, when we see the labor weakening and we see falling inflation, that's when we're actually going to see rates improve, and rates will finally come down from that. So that's my view. What do you think, Michael?
Yeah, from my perspective, like picking the other side of that, I would love to say that rates are going to come down, and there's some indicators that they could potentially come down, but it really is going to depend on the Fed and what they're doing for sure.
I hope to
And
be
like
wrong, and I hope that you're right, and that rates do get better before they get worse. Everybody, I want you to
yeah,
know I would gladly be wrong on this one. I hope Michael is right.
yeah, I wish I could be.
You know what's
So
funny is,
I guess I'm hopeful.
God, yeah.
No, I just said I'm just hope. I guess I lean on the hopeful side of things.
On the hopeful side, yeah. So either way, I know that this is, not what people want to hear. They don't want to hear that rates are going up. And by the way, I do want to say I did see the comment from Godfred, and we're going to come back to your comment, Godfred. I'll let you know that in a moment. But the basically when rates go up like this, we're seeing a lot of home buyers now go to the sidelines. They're like, whoa, whoa, whoa. I think I need to wait for rates to come down. Do you think that's a good idea or a bad idea?
I don't think it's ever a good idea to play the market on a rate, because rates can always change. Rates can go up, rates can go down. We know over time, when you look at the long play, there's always opportunities to refinance in the future. Now, whether that's coming next year or in 5 years, we don't know that. Like Hammer said, there's no crystal ball to know what it is. The truth is, when you're buying a home, you are creating wealth. You're providing an investment into your future, and by doing that, and getting the actual equity that's in your house, you're better off than having 100% rate. I don't know if
Yeah.
anybody knows this, or I'm sure they do. When you're paying rent, you are essentially not paying a 7% interest rate. You're paying 100% interest rate because you are paying someone else's mortgage, and you're just sitting in a piece of property that you don't own. You don't gain equity. There's no benefit to you other than the fact that you get to use it, and that's all.
Yeah, no, I absolutely agree. And that's why some other things that we've talked about is that, with rates being where they're at right now, there's a current home buying advantage. That advantage being that you're going to go ahead and see less bidding wars. There's not a lot of inventory out there, y'all. People are sitting on their houses because over over $4 trillion worth of mortgages were done last in 2021 into 2022. And people have 2-3% interest rates. They're not moving. So because of that, normally when we see rates move higher, especially as much as we've seen, home prices would drop, and it wouldn't be a bubble, but we would see home prices drop. We've not seen, if you look nationally, we've not seen home prices drop. They're slowing down much less significant. I mean, sorry, they're increasing much less significantly, but there's been a big slowdown, but they haven't really dropped. In some markets, they've gone down, and some price points have gone down. But when it comes to what I'm going to call affordable housing, your first home or even your second home, those homes, there's not a lot of them out there, so they're not really moving. Right. So that makes it a good time now to buy, because with rates being where they're at, there's less people out there looking, and you get a better shot at getting it. So another great question. Let's go ahead and put Godfred's question up here. So thank you, Godfred. We appreciate you asking. Again, if you have any questions, y'all, we're here to answer them for you. And Godfrey wants to know, how does it work buying a second house? I purchased a house last year in August and planning on getting another house to use for home care. Do I need to stay for 1 year to get another? So I'm going to defer this one over to you to kind of go into a little more detail as a vetted VA pro.
All right. If you're talking about specifically using your VA loan to purchase a second home, the VA does not allow that in that manner, meaning you can't buy a second home or an investment property. You have to use it as your primary residence. So if you're planning on buying a home that you can move out of your current home, move into the home that you're going to be purchasing as a care home, I think that would be totally fine. You could definitely do that. If you are saying, hey, I just want to create some wealth and provide another income stream in an investment property, the VA guidelines don't allow for that in your VA loan.
Right. So just to summarize and clarify the way that I heard it, Michael, what I heard you say is, if Godfred were to stay in his current home, he cannot use his VA benefit to buy the new home and use that as a second home or for home care for any purpose. However, if he moves out of his current home, and that home were to be a second home, and bought a new primary residence that he was living in full time, then he can use his VA benefit again. Is there any difference in how much would he be able to take as much as he did last time, or is there a difference in that?
That really depends on how much eligibility he still has remaining on his VA eligibility. The best thing to do there would be to certainly reach out to a mortgage professional that can help you calculate what you have left in your eligibility and determine whether you're going to need to put a down payment down, or if the new home, not the second home, the new home was going to be covered 100% with the VA loan.
Right. So that's something, Godfred, and everybody else watching, that you want to be very aware of. You want to find out for your unique situation, maybe talk to one of our vetted VA specialists. And, I'll tell you, Michael, there's people that have great creative ideas. Like maybe Godfred's neighbor says, hey, don't worry, just buy that new house and tell them you're going to live there all the time. Is that a good idea or a bad idea?
Oh, that's not a good idea. That's called mortgage fraud. It's called occupancy fraud, because you're claiming you're doing something that you're not actually doing. There's a lot of people that have tried that. Occupancy fraud can call the note due immediately, create a foreclosure situation, put your credit at risk. And not only put your credit at risk, you could potentially even face charges for fraud.
Yeah. So you never want to say that you're going to live there if you don't live there. So that's always a bad idea. So yes, Godfred, technically when you currently own your home. All right. So if you buy this new house and you're calling it a second house, so we'll say your second house, you have to use it as your primary residence. In order to use your VA benefit, you can only use it on a primary residence. Now, that doesn't mean you can't buy a second home. You could buy a second home using a conventional loan, but you're going to need a significant down payment for a second home. And when you talk about a second home, there's two purposes. If, like, let's say that I live here in the Smoky Mountains, it's a beautiful area of North Carolina, a few hours away from Michael, and I want to buy a home at the ocean. Let's say I want to live in the Outer Banks of North Carolina. I want to buy a home there that I can rent out, but I can use it in the off season, right? If I buy a home that I'm going to stay at, that's a second home. And if I buy a home that I'm going to use as a rental property and I'm going to rent it out full time, either, short-term rentals like Airbnb or long-term rental, that's an investment property. So there's different categories. And just like Michael and I were talking about, you don't want to lie about this. It sounds like a good idea to some people and they talk about it. I'm not here to judge, but I will tell you that it is a bad idea and it can bite you in the bottom big time. So not suggested that you commit it is a fraud and you don't want to commit fraud. But as far as if you were to decide, okay, I'm going to use my current home and I'm going to rent it out and I'm going to buy a new house, then you may be able to use your VA benefit. And I say may. Michael, do you say may or definitely? Right? I think we said may because of eligibility. And then what about the 1 year? Is there a requirement for how long you have to have had the first home before you can buy a different primary residence?
No, there is not. There's a form that you sign when you're filling out your all your paperwork at closing that does say that you intend to live in the home. It does not require that, something comes up, you want to make a change. We had somebody here in Vetted VA ask this question recently, where they bought a house and they lived really far away from their family. And then they got homesick and said, you know what, I don't want to live this far away from my family anymore. I want to move back. And they asked the question, do I have to stay in my house for a year? And the answer is no. They don't have to stay in their house for a year. The best intended use that this particular veteran had was that he was buying his first home and he wanted to live here and then got homesick and now he's making a change. It's not a benefit to him at this particular moment to sell the property because he would be underwater or he would owe money to sell it. So it's better for him to keep it and find a place, find someone that can rent it out from him. and then he can move back home closer to his family.
Yeah. And Godfred, just like in this situation, and by the way, you're welcome, certainly glad to help you with this. Generally, when you're buying another house, if you say you're going to live there, the underwriter is going to scrutinize it. Their job is to make sure that they're not committing fraud. So they're going to look at how far away do you work from this other property? Why are your reasons for moving to this other property? Is this either an upsize or a downsize? Why did you make the move? Like, they would do what's called a letter of explanation in the case of the scenario that Michael just said, where somebody would say, look, this is where my family lives. We have to, we see them multiple times. We found it's just too far away. And the underwriter has to assess that. They have to take all this into account. It's not just, well, he said that he's moving because he misses his parents and that's good. They really scrutinize this stuff. So, and they have to protect you guys and protect the program. So just realize that that's something else that you want to factor in. And Godfred, if you were to buy a second home, again, it's usually going to require, if you're not buying a new primary residence, if you're buying a property as a second residence or a second investment property, then you're going to find a lot more down payment and a lot higher interest rate. And that's because of the risks associated with those properties. If we see a downturn in the market, they're the ones who very to give up their primary residence. It's their home. But investment properties or second homes are a little bit quicker to slide. And that's why underwriting and guidelines and all the factors that go into that make those higher interest rates and higher down payments for the risks. So, all right. Well, Michael, thank you again. Thanks for answering those. Godfred, glad we could help you today. And any other questions or comments anyone has, please go ahead, drop them in here. We'll be glad to answer them for you. Otherwise, Michael, thanks for joining us today. Anything you want to leave everybody with?
Not really. I mean, watch out, keep an eye on the rates. Definitely get with a mortgage professional here at Veta VA to help walk through any scenarios that you may have, and ask any questions here in Veta VA. That's what we're here for. We're here to help you hopefully calm your fears and answer any questions you have about the VA loan.
Very good. So, well, I'm about to hop on a plane and head out to Hollywood, Florida for a mortgage event, y'all. But remember, you can join us each week. We're here at 12 p.m. Eastern, 11 a.m. Central, 9 a.m. Pacific, and 10 a.m. Mountain. See, I switched them up on you to make sure everyone's paying attention. So anyway, thanks again, Michael, for joining us. I appreciate you. Take care, everybody.